Hello traders, I'm back with one more very interesting video as the slide represents. This is one of the adjustment wherein we will be like differentiating between the normal retailer adjustment versus the smart retailer adjustment. So after watching this video, you try to put yourself into either this bucket or this bucket. Alright, so maybe the normal retailer adjustments would not have many shades because they are just influenced. That's what they have been taught by all the trainers. They just do the copy paste because majority of the retailers are doing the same thing, and we all know, right? We all know majority of the retailers will end up losing their capital. So when you do the same adjustment the way the 99% of the retailers does, you'll definitely, needless to say, but just watch this video and you come to one conclusion. I know, see, before I start making this video, right, I know definitely there will be few people who will be like saying what if, else, that and this, but I'll clear it out all your doubts. Okay, but just before we start the video, the smart retailers will always have the view or levels in their mind or on the chart. Calculated risk, they know the risk, right? There are two things, risk and calculated risk. Every time it should be calculated risk, not risk. VIX, which is very important because end of the day we are not so-called option sellers. Don't ever call yourself as option seller, but instead you call yourself as volatility trader. And then out of box adjustments, this is not at all out of box adjustments, this is one of the common sense adjustment. Okay, so let me take you to the simulation. So before taking you to the simulation, right guys, I want to show you the market view. Right, I wanted to just implement this simulation for 16th Feb start date, and what is the end date? End date was almost like 21st Feb expiry. That's it. See, you can take any of the expiry. This is going to be like very simple adjustment, guys. This is going to be like very simple adjustment. So I wanted this falling market. Okay, so now based on this, what I'll do, okay, based on this, what I'll do is like, see, I went to simulator in Sensible. So I've taken the 16th as the start date and 23rd as the end date, 23rd end date. And then what I've done is like, I've just taken an iron fly as an example. You can take any strategy. You can take any strategy. The thought process, the mindset applies same. The only thing is like the strategies will vary. All right, so let's say you might have deployed a what do we say, iron fly on 16th Feb. What is iron fly? Basically at the money straddle, okay, minus at the money straddle, and then followed by two edges. So you got almost like 300 credit, 300 credit. So this is like cumulative of 650 or 630 credit you got. So you have taken 600 away from both the straddles, the edges, right? We're not discussing the iron fly. If someone is new to iron fly, I would recommend you to go and watch my playlist on the iron fly, then only you'll be able to understand. All right, so now what adjustment? Okay, let me take you to 30 minutes. So at the close of the day, at 3:30, the straddle looks like this, right? It market went down, so your view was sideways. Basically when you deployed the iron fly, right, you should not regret the fact that your view was sideways, right? At 3 p.m, at 3:30, almost at the close of the day, your straddle was standing here. So let's see what happened the next day morning at 9:15. Right, next day morning at 9:15, it is almost at your break even. So now, right, the thought process, I mean all those calculations, the gambler mindset, some smart traders will have their own levels, all those calculations will come into picture because your straddle was here and all of a sudden it is at your break even, it is at your lower break even. Okay, you'll wait for another 5 minutes, 10 minutes just to see. Now 9:25, the market stands here, right? Someone would have done the adjustments by now, someone would have done the adjustment, but we wait, right? We basically, again it went up, right? Again it went up at 9:35. See, again it came down, right? It went up, it came down. So this is what happens, right guys? This is what happens, right? Now all of a sudden at 10 o'clock, see, 10 o'clock it went up, right? I'm just intentionally showing you. Now at 10:15, see, that has breached your break even. So now from 9:15 till 10:15, it was 1 hour. Okay, so market has sustained basically. You have deployed this trade as a non-directional, but now you have to think. So now I'll tell you two things, guys. Now I'll tell you two things. One thing is like, let me take you to chart. Okay, let me take you to chart. So what is a 10-15 somewhere, right? So maybe what I'll try to do, see, this is my price action. I might be right, I might be wrong. So maybe what I'll try to do is like, I'll just try to put maybe this thing. Okay, so I deployed the trade here, market came down. So at what time is it? So maybe like 10 see 10ish, same, right? At 10 o'clock or 10:15. So this has breached my support line, because this acted as a strong support, second time, third time, and also fourth time also it acted as a support. It went up, but it could not sustain, it broke down. So now what I'll do, I entered somewhere here, market came down, but now my view should change. So this is what I call the levels. Now I think, okay, I was sideways, basically I was sideways, but all of a sudden my support got breached. So let me do one thing. So there are like only two standard adjustments the retailers will think. Let me again take you back to this thing, guys. Let me again take you back to this slide. Okay, where is that? Okay, so two standard. One is, okay, rather than me telling theoretically, directly let me tell you. So what I'll try to do is like, I'll just go to, guys, listen, right? I'll just go to option chain. Now I clearly saw that my support got breached. So now when my support got breached, so I will be like bearish, not super bearish, but I don't know, market will fall like this until this thing, right? My only temporary view was, okay, I was sideways, market has breached my support line, I have to be like bearish. So now what I'll do, what is market is standing at 41,435. okay, my adjustment, the smart trader adjustments, and then I'll show you the what the normal retailer adjustments. Okay, 41,400. Let me go and check 41,400. See what I'll try to do, guys. I know now the questions would come up, what is this guy doing? So now when my view is bearish, when the support has been breached, I'll not think about selling a call, guys. I'll explain everything. I'll just try to buy this naked put, because we know, right, what did I say, when the market is going down, you have to take the advantage of rising wicks. Point number one, your view as supported, right? Third one is, what did I say, risk. Even though I'm buying this, let me buy this. Okay, let me take you to so this is how the payoff will become. But guys, don't give importance to this payoff. This will look like weird, but what you have to work is, you have to just look at this premium. So you bought it at 282 premium, right? Two things, either this premium has to reduced or it has to increase. That's it. If this premium reduced by 50 points, you exit the trade. If this premium increased by 50 points, you start trailing the stop loss. Got it? Because you bought a put, so you want your premium to increase. Understand, guys? Okay, if this decrease, you have a strict stop loss at 50 points, and you can trail every 50 points. Now this 50 is variable XYZ. That's it. You decide whether this is 20 points, whether this is 30 points, 40 points, 50 points, 60 points, 100 points, based on your trading style. Now don't come and tell me how much of points I need to put. Can I put 2 points? Can I put 100? It all depends on your trading style. Alright guys, so now what I'll try to do, that's it. I'll put a stop loss into my system. That's it. Either this has to go up. If this goes up, this premium goes up, I'll be in profit. If the premium comes down, at some point I have to exit the trade. Okay, so let me take you to 30 minutes or 15 minutes, guys. Or else let's take to 30 minutes. That's it. We are done almost, right? Now 289. I'm not at all in panic. Just keep an eye on this thing, guys. Keep an eye on this profit and loss. Okay, next 15 minutes, right? 465 is a profit. I am not at all at panic. Next 15 minutes, 806. This is increasing. So from 282, this got to 330. Now if you want, you can trail your stop loss, but I'll not tell all these basic things, guys. Now if you want, you can trail your stop loss. Okay, to now 282, right? Maybe your stop loss was maybe at 220 something. Now you can just get it to cost. Okay, another 15 minutes, guys. Let me quickly take it, right? Just keep an eye on this profit and loss. 15, 15, 15. Okay, 12:30. We are at 12:30, 12:45. See, check the profit, guys. Now 4,000. Right? Let me go over. See, either I'll exit, not exit. Either I'll exit my this leg. Basically, you are a option buyer because you bought a naked put. You should act as an option buyer. What is the profit of option buyer? That's the intrinsic value. You get such a good intrinsic value, 282. It was 282. Now it is 526. Just in case if the market falls, you will unnecessarily end up losing your hard-earned intrinsic value. So now I would strictly say at 1 o'clock, exit this leg, guys. Exit this leg. Now let me take you to the payoff. Okay, let me delete this. Okay, now you might be thinking, many of the major watchers might be thinking, this guy know the view of the market. That, see, I do not know the view, right? I did not see. I'm not even taking this into consideration, right? You'll get to know. 1 second, right? This was something like this view, right? And then the moment it got breached, so slowly the market is going down. Now what you have to do is like, that's it. You have to exit this leg. Why will you end up losing the hard-earned money, right? I'll exit this at 1 o'clock, and you now check the magic, right? I'll take you to the payoff. Your trade has become green. Basically, your trade has become green with only one adjustment. And what was that adjustment we did? We did with the levels, we did with the view. That was not a random adjustment. We took the calculated risk. Yes, we took the risk, but calculated risk of 30 points, 40 points, 50 points, 60 points based on your trading style. We bought the VIX into consideration because when the market is falling, obviously the VIX will shoot up. Rising VIX will shoot up the buy premiums. Rising VIX will shoot up the buy premium, and we were the option buyer here. Out of box, it's up to you whether you call it as out of the box, or you call it as a common sense adjustments, or you call it as a you name it basically. I'll come back to this thing also. Okay, now let me again take you back to the trade. That's it, guys. Your trade has become green. Now you can just hold. Still, you have 16,000 profit just in case if the market takes a U-turn. Right, that's it. You have exited. You can hold this trade with peace of mind. Now if you are anticipating that I'll be like showing you the further simulation, sorry guys, you have to do that simulation. Now let me show you one thing. Guys. So let's say you bought a put here, you might have sold somewhere here, you might have squared. Again you get a put, you might have sold here. So let's say you might have bought a put here, I'll tell you. Now market went up, right? Exit with this stop loss of 50 points. And believe me guys, your trade, see, when the market is going up, let's say you bought a put here now, okay? If the market goes down, you will get with good profit. Your profit will keep on increasing. Let's say the market came up. You bought the put here. The market goes down. Your naked put will give you profit. Just in case if the market goes up, though your naked put will give you 50 rupees of loss, but your trade will become balanced. The market will come here again, guys. The market will come here into your green zone, and you check if the market comes here, check the profit, guys. Let me delete. This is what, let's say the market comes here, check the profit, right? You will be getting with 7,900 profit on the T+0 day. You got it? So either way, that is called the calculated risk, guys. That is called the calculated risk. If it goes down, my naked put will give me the profit. If it comes against my view, my trade will again become balanced. See, there are like too many things I can discuss, but sorry guys, I cannot discuss each and everything because the video length will become lengthy, right? You have to think about all this smaller things into consideration. Now I'll show you what the normal retailers will do. Okay, let me delete this leg. Okay guys, let me delete this leg, and then let me take you to 10 o'clock or 10:15 somewhere. We have done this adjustment. Okay, let me take you. Normally what other retailers will do, the majority of the retailers, okay, we'll take the same example, right? Maybe 10:45 or 10:30 something. Yeah, 10:30. Now everyone are gone. Let me again take you back to that slide, right? Influenced, copy paste, that's what they have been taught to do. So what they do is like every YouTuber tell that when the market stands at the downside, go and sell the naked call. That's what you know it, right? That's it. When the market stands here, the only thing what you do is like you try to sell from the opposite side. Let me give it a try. Okay, so where is the market standing? The market stands at almost like, what is this, 42,200. Just check this, 42,200 is your break even, right? 42,200 or 42,300. Let me take you to option chain. Okay, 42,300, it is 42. So let me sell this. That's it, right? This is what we do when we sell this unnecessary. The what do we say, the margin will increase, because this is a what do we say, this is a sell basically, right? Your margin will increase. Let me see, right? Yes, you sold it. Let me do the same simulation, right? Keep an eye on this profit and loss. Next, anyways, market is going down, right? When the market goes down, your call sale will give you profit, obviously, right? Let me go to 15 minutes. Keep a check on this thing, guys. Keep a check on this profit and loss. 15 minutes, 15 minutes. I'll just go till 1 o'clock. I'll not try to extend this video. 15 minutes, 15 minutes, 15 minutes, 15 minutes, 12:30, 12:45, 1. Right now you check whether you got in profit or loss. Now let me show you the sold position. 48 rupees, guys. You bought it for 48. Technically it went by 10 rupees down. You are in profit just with 250t, but check the overall trade. Your overall trade is 1,232 because of, see, basically when the market is falling, alright guys, the VIX will shoot up. Okay, so ideally technically your VIX has reduced here, but did you get into profit? Ideally check about the other three trades, right? Check about the other three legs, because you are doing the wrong adjustment. Got it? Every time if you're selling from the call side, right, the premiums will not decay to that extent, because 1-2 hours the premium has decayed only for 10 rupees because VIX was rising. Then why the hell we should think about selling a naked call? Yes, I would do one thing, guys. I would do one thing, right? What I suggest you to do is like, first go for my first approach. Buy the call, buy the put at 1 o'clock or close of the day, exit that put, and then you sell the naked call. Now, why are we selling the naked call at the end of the day? Because to get the theta decay benefit during the overnight. You got my point? Do the first approach. Buy the naked put by putting a strict stop loss. The moment your stock is giving, the buy is giving you the profit, exit that put leg, and then end of the day you sell one naked call just to get the advantage of theta decay for the overnight. The next day morning, if the market open flat, exit your call. Exit your naked call, and then again, based on the view of the market, you have to decide whether to go for naked buy or to go for naked call, right? Let's say even if you went for naked buy here, if the market went up, exit with the stop loss of 50. Check whether the market is coming down, right? If this has breached your support level, then go for put buying, right? You capture this moment, right? Here you might have failed. Just in case, if you might have bought the put here, capture this moment, buy the put here, capture this moment, buy the put here, capture this moment. You got it? So I'll not extend the video, guys. I'll just stop it. All the smart traders might have understood. If you think that you have learned something new, guys, just give it a thumbs up and comment in the comment box saying that yes, this makes sense, because end of the day we have not done any random adjustment, right? We have done the adjustment backed up by view levels, calculated risk of 50 points, considering the VIX into picture. If you think this is out of box, it's up to you. We were not influenced. We did not do the copy paste adjustment, right? This is what trainers will teach them. You try to be volatility trader. Never ever call yourself as option seller. So if you like my video, guys, please like my video. If you want to subscribe my channel, you can, and also please share with your friends. All right, thank you, guys.